and welcome everyone to Mission Yeshas. Day 6, we'll be starting with the concept of demand and elasticity of demand. Now, after you watch this video, please go back and revise that particular topic. And the source material would be the Yeshas notes or your ICI material. If you want further elaborate explanation, then you can also look at the marathon session, which the link of which has been pinned in the video below in the description. So let's begin. First of all, when we talk about demand, we know that demand correspond to your willingness and desire and the ability to purchase that particular commodity. All right, willingness or desire means the same thing. So when we desire any commodity, it will not create demand. You must have the purchasing power, that is the ability to buy any commodity. And then there is a negative or inverse relation between price and quantity demanded, because Alfred Marshall, as he stated, that increase or decrease in price will affect the real income of the consumer. So it means if the price of any commodity increases, the real income of individuals and household will decrease, decreasing their purchasing power. And because their purchasing power decreases, there will be decrease in quantity demanded. Whereas just the opposite, when price decreases, then real income of the household increases. It means your purchasing power will increase because the same quantity of goods you can purchase at a much lower price. This saving will motivate you to buy more. As a result, quantity demanded will increase, and due to which there is a negative or inverse relation between price and quantity demanded. It means if I have to plot the demand curve, we'll take price along the y-axis and quantity demanded along the x-axis. So initially, if the price is P0, you'll see that the quantity demanded will be at the higher end, Q0. But when the price increases from P0 to P1, then quantity demanded will decrease from Q0 to Q1. This is the basic knowledge about the law of demand. Now also remember the elasticity of demand. Now we will be focusing on all the important aspects from where you're going to get a lot of questions, right? Lots of questions. So around 70-80% of the questions would be what we get from the topic will be covered here. If you want any additional idea about that particular topic, you are free to read any material. But this will help you get easily 70 to 75% in your examination. So now when we talk about elasticity is nothing but the responsiveness of the consumer. It means how do I respond when there is a change in price. So when there is a change in price due to which there is increase or decrease in quantity demanded, we call it as price elasticity of demand. What do we call it as? Price elasticity of demand. All right. Whereas if the demand changes due to changes in income, then we call it as income elasticity of demand. And if the demand changes due to changes in the price of related items, say for example, there is an increase in the demand for petrol cars because the price of petrol is falling, then we call it as cross elasticity of demand. Now remember, when we talk about elasticity, there are various methods to measure this elasticity. And the two most prominent methods from where you get a lot of questions are proportionate method and total outlay method. So under proportionate method, if we have to calculate elasticity of demand, we say what? Percentage change in quantity demanded divided by percentage change in price. So percentage change in quantity demanded divided by percentage change in price. All right. And the formula for the same is Q0 minus Q1 divided by Q0 into P0 divided by P0 minus P1. Now you'll find since there is always a negative relation between price and quantity demanded, you will always get a negative answer. But elasticity cannot be negative. The reason why you are getting a negative answer is because of inverse relation between price and quantity demanded. So we have to ignore the negative sign. Now there are degrees of elasticity. When you talk about, there are 5 degrees of elasticity. That is E greater than 1, E less than 1, E equals to 1, E infinite, and E 0. So when E is equals to 1, then we can say that the percentage change in quantity demanded and percentage change in price will be the same. It means if the price is increasing or decreasing, let's say by 10%, then quantity demanded will also, if the price is increasing, it will decrease. If the price is decreasing, it will increase, but by the same percentage. That's why you get E equals to 1. We call it unitary elastic demand. Whereas if E is greater than 1, then the percentage change in quantity demanded will be higher than the percentage change in price. So if say price is increasing or it is decreasing by 10%, whereas quantity demanded, if it decreases or increases by more than 10%, that is, let's say 20% or 15% or whatever, then you will get E value 2, which usually is found in case of luxury goods. And when E is less than 1, which is usually found in case of goods for which consumers have a very strong preference. So if there is increase or decrease in price, the quantity demanded is not going to change much. So it means if suppose, let's say the price increases or price decreases by 20%, then quantity demanded will decrease or increase depending on whether the price increases or decreases, let's say by 10%. So you're getting half here or 0.5 as the elasticity of demand. But here, so it means if you get elasticity diagram, in this case, what happens? You see, you'll get a downward sloping demand curve. Here the difference between the percentage change in quantity demanded and percentage change in price will be the same. But when you have E more than 1, as the elasticity increases, the demand curve will become more and more horizontal and less vertical. Now let's say if the price was P0 over here, quantity demanded was over here. Now if the price increases, let's say by 10% from P0 to P1, quantity demanded may fall relatively bigger than change in the price. So you'll find that demand curve will become more and more horizontal and less vertical. Whereas if E is less than 1, then what will happen? You'll find that the change along the quantity axis will be lower compared to the change along the price axis. Now in this case, when this is the price and this is the quantity demanded, let's say P0 and Q0, if price increases from P0 to P1, let's say by 20%, but the quantity demanded falls down by a relatively smaller margin, so you will get a demand curve which is more upright, which is less horizontal and more vertical. Whereas if suppose E is equals to 0, it means when do you get E equals to 0? When only percentage change in quantity demanded, there is no change even though there is a change in price. It means demand is changing due to factors other than price. In this case, price may increase or decrease by any percentage, but quantity demanded do not change, it remains constant. So in this case, you will get a demand curve which is a vertical straight line, and you can see here price may increase from P0 to P1 or it may decrease, but the quantity demanded remain same. So you get a value that is E equals to 0. Whereas if E is infinite, then what you'll get in this case, the price remains constant. The price remains constant and still there is increase or decrease in demand by any percentage. So in this case, you will get a horizontal straight line. Now you can see the price is remaining constant, but the quantity may increase from Q0 to Q1 or Q1 to Q0. This is under proportionate method. Now under outlay method, total outlay method is also known as total expenditure method. We try to figure out what will be the effect on consumer expenditure when there is increase or decrease in the price of a commodity. But again, you remember that whether the expenditure increases or decreases, it depends upon the elasticity of demand. So we say if suppose E is equals to 1, then what will happen? Increase in price will not affect the total expenditure of the consumer. Total expenditure will remain constant, because if the price increases by 10%, quantity demanded by falls down by 10%, you're neutralizing the effect of increase in price. And if the price decreases, then also total expenditure remains constant. Whereas if E is greater than 1, then price and expenditure move in the opposite direction. Meaning what? If suppose price is increasing, total expenditure will decrease. If because the price is increasing, let's say by 10%, you are decreasing your quantity demanded by 20, 30, 40%. So of course you're spending less, so your expenditure will fall down. And when the price decreases, then total expenditure will increase. So in this case, when E is greater than 1, always remember that price and total expenditure move in the opposite direction. On the other hand, if E is less than 1, then price and expenditure move in the same direction, because in this case, when the price increases, total expenditure will also increase. Let's say price increases by 20%. You are not able to decrease your demand by 20%. You are able to decrease by 2, 3, 4, 5, 6% or so, maybe by 10% also, but your response is lesser than the increase in price, means there is still burden left on you. So in this case, what will happen? Total expenditure is going to increase. And if the price decreases, let's say price decreases by 5%, or let's say price decreases by 10%, but the demand increases by 1 or 2 or 3 or 4%, in that case, your total expenditure will also decrease. So E greater than 1, price and expenditure move in the opposite direction, and E less than 1, price and expenditure move in the same direction. When E is constant, E is equals to 1, then price and expenditure, expenditure remains the same irrespective of the change in price. Then we come to the concept of total outlay method. Under total arc elasticity method. Under arc elasticity method, if there is a big change in quantity demanded, you cannot measure it at a single point. You have to measure it to different points, for which we use arc method. Sometimes even very theoretical question is asked as to when arc method is utilized. So for arc method, the formula will be Q0 minus Q1 divided by Q0 plus Q1 into P0 plus P1 divided by P0 minus P1. As simple as that. Only the formula is different. And when you talk about point elasticity method, now point elasticity method is used in case when the change in quantity demanded is very small due to an insignificant or very minute or small change in price. So in that case, you measure the change at a single point on the demand curve. So in this case, if I take price over here and if I take quantity over here, you'll find that, let's say A, B, C, D and E. At the midpoint, you will have elasticity which is equals to 1. At the point when it's touching the y-axis, you have elasticity which is equals to infinite. At the point when it's in between the midpoint and the point when it touches the y-axis, you will have elasticity greater than 1. And at the point when when the demand curve touches the x-axis, you will have elasticity equals to 0. And the point where which is in between the midpoint and the point when it touches the x-axis, you'll have elasticity lesser than 1. And the formula to determine point elasticity is simply we divide the lower segment of the demand curve with upper segment of the demand curve. So it is lower segment divided by upper segment. Now next comes to income. So remember, in case of income, depends upon which kind of commodity you're talking about. If income increases, the demand for normal goods will also increase, but more or less you'll find that in case of income and demand for normal goods, you'll have a E which is lesser than 1 or maybe close to 1, but it will be less than 1. Whereas in case of luxury goods, we are attracted towards luxury good. So even if our income increases by, let's say 20 or 30%, the demand for luxury goods will increase by a greater proportion. And when our income decreases, we know that luxury goods are non-essential, so we will first give up the luxury goods only. So in that case, you'll have income elasticity to demand which is greater than 1. Right. So remember, both normal and luxury good, the relationship is positive. It means income increases, demand also increases. But for normal good, you'll find E is less than 1. And for luxury goods, you'll find E is greater than 1. For necessities, now in case of necessities, it depends upon whether you're talking about short run or long run. In case of necessities, if they don't mention short run or long run, you will always assume short run. In the short run, if the income increases, the demand for necessities may increase by a small margin because people make mistakes. But in the long run, they will realize that mistake, and so whatever increment they would have done in the short run, they would decrease it back to the same original quantity that they should have bought. So for necessary goods, you have short run and long run concept. In the short run, E will be less than 1, whereas in the long run, E will be equals to 0. Right. Now remember, in case of inferior goods, it is the inferior goods only in which case the elasticity of demand will be negative, because logic says if my income is increasing, why will I buy garbage? Correct? I will want to improve my standard of living. So in this case, if income increases, demand decreases. So you have a negative income elasticity. Negative income elasticity of demand. So only and only in case of, remember, inferior goods, there is negative income elasticity of demand. Otherwise, it's always positive income elasticity of demand, whether you're talking about luxury good, or you're talking about normal good, or you're talking about necessities. Clear? Next comes cross elasticity. We know that goods which are complementary goods, in that case, the cross elasticity of demand will be negative. So when we're talking about cross elasticity of demand between two commodities, then we know that if the price of petrol will increase, demand for petrol car will fall down. If price of electricity increases, the demand for air conditioners will come down. Right? If the price of sugar increases, demand for tea will come down. So you're talking about complementary goods. There is an inverse or negative relation. So we call it that there is a negative cross elasticity of demand. In which case? In case of complementary goods. Whereas in case of substitute goods, the elasticity of demand is positive. Simply, if I want to buy a new Reebok shoe, but I'm getting a good discount in Nike, it means Nike has reduced the price. Will I not go ahead and buy Nike? So it means the demand for Reebok will come down. So I wanted to buy a Kia car, but I got a good discount in Maruti. Maruti is reducing the price. So people who wanted to buy Kia, they will now buy Maruti. So demand for Kia will go down. So in this case, you have positive relation. So if Pepsi increases the price, then demand for Coke will increase, because people who are buying Pepsi, they will go and buy Coke. So you have positive cross elasticity of demand. Now two commodities which are very close substitute, it means, say for example, two different brands of milk, two different brands of yogurt, they are very close substitute. So in that case, people can easily replace one with another, very easily. So there will be a high degree of substitutability. You will not have difficult time in changing. You'll not have difficult time in changing the preference, because they are more or less the same commodity. So in that case, what will happen? The cross elasticity of demand will be very high. E will be greater than 1. So close substitutes have high degree of substitutability. So E will be greater than 1. And two goods which are completely unrelated, in that case, the cross elasticity of demand will be 0, because I don't want to replace a hair oil with a potato chips. Clear? So in this case, the cross elasticity of demand will be 0. So cross elasticity of demand, when you're talking about 0, when goods are unrelated. related. Clear hai? When goods are unrelated. So let's quickly look at some of the questions. These are the questions which are given at the back of ICA material. So you see, let's solve these questions first. You see here, straight away point elasticity method. In case of straight line demand curve meeting two axes, the price elastic demand at the midpoint, we know at the midpoint just now we have learned E will be equals to what? 1. Now, you see, in case of inferior goods, the income elasticity demand, we have learned it is negative. Right. So you see, he is given demand for good is inelastic. Increase in price will cause the total expenditure. This is the outlay method. So E is less than 1. We know that price and expenditure move in the same direction. So price increases, total expenditure will increase. Price decreases, total expenditure will decrease. So they are saying what? Demand is inelastic, increase in price. So price increases, so total expenditure will also increase. So the total expenditure of consumer of good will increase in this case. Regardless of the change in price, quantity demanded of good remains unchanged. It means quantity demanded remains unchanged. It means it remains fixated at the same point along the quantity axis. So in this case, E will be equals to 0. And you will have a vertical or straight line which is parallel to the y-axis and it touches the x-axis. Okay. Let's see some other questions. You see, if electricity demand is inelastic, E is less than 1, and electricity charges increase, it means price increases. So we know when E is less than 1, price and expenditure move in the opposite direction. So total expenditure will fall. But this is not related to expenditure. This is related to elasticity. So it means if E is less than 1 and let's say price increases by 20%, then don't you think quantity demanded will fall down by less than 20%? So there will be a relatively lesser fall in quantity demanded. So quantity demanded will fall by a relatively smaller. Relatively why? Because relative to the price. We are always measuring the price, always through the law of demand. Right. Now you see here, direct question, theoretical question. I've told you point elasticity is useful for which of the following situation. I've told you that point elasticity method we use only when there is a change in quantity demanded, it is very small due to a minute change in the price of a commodity. So here you see the bookstore is considering doubling the price of the book. Of course, when you're doubling, you're increasing the price by 100%, there'll be a big fall in quantity demanded. All right. So arc method will use, not point method. A restaurant is considering lowering the prices of its most expensive dishes by 50%. Again, 50% is not a small change. So here also we'll use arc method. An auto producer is interested in determining the response of a consumer of a car being lowered by 100 rupees. Now, it will not matter to the people who want to buy a car if the price increases or decreases by rupees 100. But if there is a change, this change will be so small, so minute that you cannot measure it between 2 points. So in this case, we'll use point method. So answer C will be your C will be the correct answer. Question 9 is related to outlay method. Remember, whenever they talk about expenditure, it automatically becomes question related to outlay method. So you see, decrease in price will lead to increase in total revenue. Now remember, revenue and expenditure, revenue of the seller and expenditure of the consumer are interrelated, because whatever I spend is what the sellers are going to earn as revenue. So if I spend more money, the seller will earn more money. So if expenditure increases, it means revenue will also increase. If expenditure decreases, then revenue will also decrease. And if the consumer spend the same amount of money, then the revenue will also remain the same. So you can easily change total revenue with expenditure. So they are saying decrease in price will lead to increase in total revenue. So if total revenue is increasing, can I say people must be spending more. That's why total expenditure is also increasing. Now what they've said, price decreases. Price decreases and total expenditure increases. It means price and expenditure are moving in the opposite direction. In which case it is a possibility? It is a possibility when the demand is elastic. E is greater than 1. So percentage change in quantity demanded is less than percentage change in price. No, it means E less than 1 here. So this is not the answer. Percentage change in quantity demanded is greater than percentage change in price. Yes, this is your answer. Right. Similarly, 30th question. Now they have said again, increase in price will lead to increase in total revenue. So it means if the price increases, the total revenue will also increase. So can I say if the sellers are earning more, then total expenditure, consumers must be spending more. So you see price and expenditure, they are moving in the same direction. Under outlay method, when the price and expenditure move in the same direction, when E is lesser than 1. So E is lesser than 1. It means percentage change in quantity demanded will be relatively less than the percentage change in price. So percentage change in quantity demanded is less than the percentage change in price. So A is the answer for you over here. Okay. Then you see what happens in the rice market if buyers are expecting higher price. If suppose you are given an information, a valid information, but tomorrow the price of petrol will increase, will you not go today to fill up your tank? Yes. So it means any knowledge or expectation about future increase in price, people will go and buy right now. So the demand will also increase during the current time period. So demand for rice will increase and demand curve will shift to the right hand side. All right. Given goods, remember, given goods are those inferior goods which violate the law of demand. All right, which violates the law of demand. It means law of demand talks about price and quantity demanded. So when you're talking about violation, we will not take income, will not take price of other commodities. We are only talking about price of same commodity and quantity demanded of same commodity. Now, due to violation, the law of demand becomes direct. It means price will increase and quantity demanded will also increase. So the slope which was negative in case of demand curve, it will become positive in case of violation of the demand curve. So it will be upward sloping from left to right. Now these are the important questions. There are many more questions and that you can cover. So remember the challenge, go and complete the challenge. You revise either from your book or you can also refer the marathon videos which is available. But do not go anywhere. If you have understood the topic, please comment demand in the comment. And shortly we'll start with the concept of accounts. So don't go anywhere. We'll meet again in the next session. Accounts will continue from now on. Yashashi Bhava.
Wait, did you watch the economic session before coming here? I don't know what topic did Shaandar discuss. Please do let me know in the comments what topic did Shaandar discuss. And then, welcome to CA Foundation Accounting. And in today's discussion, in your mission, Yeshas, we'll be discussing the topic of your and my favorite chapter from PU until CA Foundation, bank reconciliation statement. I know you know this chapter really well, but there are some things in this chapter which you don't usually find very comfortable, which you usually skip, and which the examiner loves. And you also don't know whether you love it or not. You will be surprised to see it in the examination paper. And then you have mixed emotions, and rest is all not in your control. Let's not do that. Let's take control of the things what you usually skip. Let's do BRS slightly unique way. Bank reconciliation statement. What exactly is this? This is a statement and not an account. Meaning, this is not like your usual ledger account that you prepare for cash account, bank account, sales account, purchase account, or what Mandumasi account. This is a pure statement. No debit, no credit. Plus and minus. Looks like Chetan sir's mathematics. But this is going to be something which is mandatory like law, how Nitika ma'am teaches. So what exactly is this bank reconciliation statement? Why the hell are we doing this bank reconciliation? Answer is pretty simple. It's like two people whom you see on the street fighting with each other, holding each other's collar, or maybe if they have long hair, they're pulling their hair also. Basically, we are reconciling the difference between two things. There are set of transactions which are seen from two different POVs, point of views. Transaction between accountant of the business and the accountant of the one transaction, money is deposited into bank. Or a similar transaction, money is withdrawn from the bank. Another transaction, goods are sold to the customer, check is received and deposited into bank. Or goods are purchased from the supplier, check is given to the supplier and supplier has deposited check with the banker. For all these transactions, it's two point of views. One, from the point of view of the business. Two, from the point of view of the banker. We see the transaction at two different point of view. When I give the check to my customer, I'm seeing the transaction today. I pass the entry today. But my businessman, I'm going to say my banker, will see the same damn transaction few months later or not months, few days later. So you will record the transactions few days later. I'll record the transactions today. Just because I record the transaction today and the banker doesn't record the transaction today doesn't make the banker wrong, doesn't make me right, doesn't make me smart, doesn't make the banker dumb. Just that we have different time zones. Now in Japan, they see sunrise today at 5. Right now in India, I have not even seen the sunrise because recording this lecture at 12 in the night. No. Recording this in the day. What I'm trying to tell you is sun has raised in Japan, but not yet in India because we're in two different time zones. So I've seen the sun, I have not. I won't tell you good morning. I'll tell good morning when I see sunrise here in Bangalore. Same way, is going to be time zone. I pay my customer, I pay my supplier by check today. Or I receive check from my customer today. I record it today. I see it today. But my banker will see a week later. When my banker sees a week later, he'll obviously write the transaction a week later, no? So this doesn't make it wrong for one of us. It's just that the transaction is being seen at a different time. So both of us are fighting. I'm holding the collar and saying, I am correct. The banker is saying, no, I am correct. In between, smart individual comes and then solves the issue saying, no, both of you are right. You don't have to fight. There is no rectification needed. There is reconciliation needed between you people. But that's not in all times. Sometimes it can so happen that one of the accountant or the banker can be wrong. If one of the accountant or banker is wrong, the person who has done the mistake has to rectify. So this is rectification of errors extended. Rectification of errors in the cash book for transactions with the bank is what we do in BLS. Here, what are we doing? We are reconciling. What do you mean by reconciliation in English? Identifying the differences to rectify the difference. If a transaction is being recorded by accountant of the business but not recorded by banker, and it's not because of time, he's forgotten to record, lazy fellow playing solitaire on his phone or laptop, PC, then it's an error. Banker has to rectify. Sometimes transaction is being forgotten to be recorded by the accountant of the business. Then this guy has to rectify. We need to identify who has done the error. If any one of them have done the error, we'll ask them to rectify. If there is no error, then it doesn't need rectification of error. It only needs reconciliation. And what we do in BRS is reconciliation, not rectification. In the process of reconciliation, if we find some errors, we'll rectify like what you learnt in rectification of errors. I hope you got good base knowledge. I will proceed further. Differences. What can be the reasons for differences? If you have to fight with your friend, there can be 100 reasons. Or if you have to fight with your husband and wife, I'm not sure if you're married or not. If that's the case, you have 1,000 reasons. And if you have to fight with your siblings, you don't need a reason. But talking about differences between cash book and passbook, these are limited. Cash book is the book prepared by accountant. Passbook is the book prepared by banker. Between them, if there are differences, they are very limited. I'll give you an exhaustive list of differences. Let's see, all differences. 5 on one screen and next 5 on the other. Let's start with the first one. Check issue. You have a customer. You have a supplier. And to that supplier, from that supplier, you purchased goods. To that supplier, you gave one check. When you gave that check, you wrote the journal entry, purchase account debit to bank. You wrote the entry already. But the banker doesn't know that you have issued a check. How will banker get to know? Banker is not spying on you through the camera of your phone. Banker doesn't know. Banker will get to know that you have issued the check only when that supplier of yours goes to the banker and then gives the check. If your supplier is high and it doesn't go to the banker immediately, it goes after a month. Banker gets to know after a month. Till then there is time gap. So you write the journal entry when you issue the check. Banker writes the journal entry when the bank receives the check. Till then there is difference. According to you, payment is made. According to the banker, payment is not made. Checks issued but not deposited. or checks issued, deposited, but not clear. Let me hide. We'll do one after the second one. Second one is you are a customer. You sold goods to the customer. What you got from supplier? Your customer gave you a check. When the customer gives you the check, journal entry is bank account debit to customer, bank account debit to debtor, or bank account debit to sales. You wrote the entry. When you wrote this entry, your bank balance has increased. But very sadly, very unfortunately, banker is not aware that the check has been received by you. You tell me, how will the banker get to know? So banker has written no entry. You have written the entry, your bank balance has increased. Banker has not written the entry, banker's books, the balance has not increased. There is an obvious difference. This is the second reason for it. Now you become a very businessman, you talk to big people, you do big things, you don't do this nonsense small work of collecting checks, issuing checks and all. So what did your customer do? Your customer understood that you are a busy man because you are not replying to messages. You are leaving your customer on scene zone like your ex. So what does the customer do? Customer will go directly to the banker. Customer will directly deposit the money into the banker telling your name and your bank account details. By this, you know what happened? Banker has received money. Banker increased your bank balance. And you, my friend, have written no entry. Why? You don't know only. Your customer didn't disturb you. He straight away went to the bank. He deposited the money. He told your bank details and damn. Now your bank balance as per passbook has increased, but your bank balance as per cash book has not increased. This is another reason for difference. Let's go to the next one. What else can happen? Next thing is, now I told you are a rich man, you are a busy man, you are not even collecting money from your customer directly. So you can automate some of your payments. Auto pay. When you take that Netflix subscription, Prime subscription, all these subscriptions, they'll ask for auto pay option, meaning auto debit option, meaning after 3 months, you don't have to renew your subscription manually. Money will automatically be cut and your life will automatically be having distractions. So this kind of feature is called payment made by banker, not standing instruction. You have given instructions to banker. Pay my monthly rent. Don't even ask me. This is my owner details. Landowner. Give him rent. This is my electricity number. Pay my electricity bill. This is my phone number. Pay my phone bill. This is my insurance policy. Pay my insurance bill. You give all details to banker and banker will automatically keep deducting your bank balance and making payment. Whenever he makes the payment, he'll write payment entry and you didn't write the entry. Why? You are lazy fellow. Lazy. You didn't write the entry. So in your books, bank balance has not gone down. Sorry, don't take it personal that I told you lazy. Sorry, sometimes truth just spits out. Okay, your bank balance has not gone down because you are lazy and you didn't write entry. Whereas on the other hand, banker has written the entry. Balance there is mismatch. Next reason for it. Let's go to fifth one. Fifth one is very simple. Receipts collected by bank. You are lazy to make payment. You are ultra lazy to collect payment also. You deposited money in some investments that will fetch you interest. You are like too bored to go collect interest. Who will collect? You told the banker, hey, collect my interest. You invested money in securities, shares of some company. You are too bored to go collect dividend. You like, banker, fetch my interest. Banker will do that for you. Banker will collect your interest on bonds. Banker will collect your dividend on shares. Banker will collect everything that you ask the banker to collect on time. And the banker collects these without you being aware, without you being disturbed. Banker has written the journal entry. When the banker writes the journal entry, in the bank passbook entry is there, in the cash book the entry is not there, because of which your passbook and cash book won't match, and that's another reason for difference. Go to next one. What do you think banker is? Your employee, your servant, your Ramu Kaka at home, your maid? No, banker has so much money. Why does he do this? Because they will cut a portion of money extra from your bank balance as their bank charges. Banker will tell, anywhere in the country you want to withdraw money, take our ATM card, withdraw. Anywhere you want to make the payment without cash, make the payment, UPI. All the services you want, I will give. Just that I'll cut money towards bank charges. So banker will deduct charges. Do you think banker will come to you, seek your permission, sir, please, sir, 100 rupees, sir, bank charges? Do you think banker will ask your permission? Banker will cut bank charges without you even getting to know, as smooth as butter. When the banker deducts the bank charges, your passbook has decreased and you're not even aware. Your cash book balance has not decreased, boss. So cash book balance has not decreased, passbook balance has decreased. There is huge gap of 100 rupees. That's the reason for difference. Hope you got it. Similarly, it's not just that you are interested in the banker. Banker is also interested in you. Why? You give so much of money to the banker, but the banker gives us loan to some other people and then collect interest. So what the banker does is to keep you happy, to show that the banker is interested in you like her. Banker will give you a portion of money that he collects as income to you. This is called interest. And when the banker has to give interest, banker will not take your permission to give money to you. Banker will not take your permission to give money to you. What will the banker do? Straight away put the money into your bank account. Your bank balance was 10,000 till yesterday. Today it became 10,200. How did you get 200? Interest credited into your bank. Why this your passbook balance increases? Cash book you have not written entry because you are not aware only. Little if you open your mail, if you open passbook and see, you will get to know. You are lost in Free Fire, Minesweeper and BGMI. The other apps are not opened only. So you're not aware and bank interest has not been recorded. Cash book balance has not increased. Another reason for difference. Going to the next item. Errors in cash book. I am a human being. You are a human being. I and you will make mistakes. I hope you understood. When we make mistakes, cash book mein there is error. Let's say the amount is 100 when I was writing in bank account or in my bank column of cash book. Instead of 100, I wrote 10 extra, 1000. Or I was very hungry. I was supposed to write 100. I ate 10. Instead of 100, I wrote 10. In that case, my bank column of cash book will show wrong amount. In passbook, they have entered correctly. So in this case, there will be errors in cash book. Like me, the banker or the accountant sitting in the banker is also a human being. And that human being also will make mistakes. There can be errors in cash book. There can be errors in passbook. Errors in cash book can be sometimes errors of omission also. There are some complicated errors like check dishonored, not recorded or something. That's not a completely new difference. It's in one of these only. And then these are the reasons for difference between cash book and passbook. What should you do? Identify all of them. Then classify them into two categories. Mistakes that is happening because of time. If the mistake is happening because of time, you don't have to worry. You just have to give time some time. No, not just showing you off some nice watch. Thanks to the previous batch students, they gave a beautiful watch. Okay, talking about time. If the error is happening because of time, give little time, that error will get solved by time. For example, you received the check, you deposited it to the bank. It's not got cleared yet. So according to you, you written the entry. Banker has not written the entry. When will the banker write the entry? Matter of time. When the banker gets that check cleared, he will write the entry. You don't have to do anything for that check to get cleared. You time some time and it will get cleared. That's error of that is timing difference. That is not error. That will get cured because of time. Some are non-timing difference. Non-timing difference means what? Here time is not what is wrong. Here you are wrong. You should do the rectification. You done some error of commission or you done some error of omission. How dare you do that mistake? I'm going to say the accountant of the business. What should you do? When you have done the error in your books, you should do rectification. So we should do rectification in our books. When we do rectification in cash book, it will look good. If not, that difference what is there today will be there even after 5 years and 10 years. I hope you got it. This is the theme of bank reconciliation statement. Differences will be classified into two. One is timing, second one is non-timing. All the timing differences, whatever are there, will continue to appear in BRS. All the non-timing differences, I'll adjust in my cash book. Non-timing differences are basically errors in cash book. If we adjust this, our cash book balance will get refined. Last and important point to note, amended cash book balance is the balance what you show in your balance sheet. What is the balance to be shown in balance sheet? Amended cash book balance. If you understood till here, continue to watch the video further wherein I will show you one spicy question from amended cash book based question in BRS. But if you understood till here and if you stayed till here, what are you waiting for? Along with that economics topic, whatever you mentioned, no, mention BRS also in your comments. You tell bank reconciliation statement and you can give a thumbs up or a tick mark and continue to watch for a beautiful question being solved on BRS. There are 100 question options that I have to solve on BRS, but nothing can beat that one beautiful question which can cover all the concept and gives you a wholesome view towards the topic. The objective in this session is not to pick the most difficult session or most difficult question. If in case the objective was to pick the most difficult question, I would have renamed this title of the video as how to make you hate BRS, but that's not my objective. Anyways, if you would still want to do more exciting questions on BRS, do let me know in the comments. I'll share you the link of a beautiful question, the most complicated question that you can ever come across on BRS. But in this video, my objective is to give you very good start into the topic of BRS, which gives you all the concepts put together at one place. Let's begin. So usually in reality, what happens is bank passbook and cash book both will be available. We have to actually identify the differences. But sadly, in your exam, what's happening? They give passbook, they ask you to find cash book. They give you cash book, they ask you to find passbook, and differences are already given. So we'll do something which is very much what happens in reality with a touch of our examination also. Trust me. Stay with me for next 10-15 minutes, and I'll ensure that you can do that. Let's begin. Messrs. Tall and Short, Faiz Bazaar, New Delhi, 11000002. Some number. That's the name of the business and the bank account. Sorry, the address of the bank. The address of the business. Then they've given that they have account with Punjab National Bank, Daryaganj, New Delhi. Okay, they have a bank account, and the bank is also in New Delhi. By the way, this is illustration number 1 from the ICI study material. A beautiful question. Skis type, teacher skis. So look at the passbook, and later they've given cash book. We just have to match whether the transactions are matching or not. If some transaction is there in the passbook but not there in the cash book, or if it is there in the cash book but not there in the passbook, then that's the point of difference. Whatever is there in one book should be there in the other book also. If it is there at one place but it's not there in the other place, then something is wrong. Shall we see what item is there at one place but not there at the other place? Let's begin. Cash 40,000. Deposit, sorry, 4 lakh. I'll erase this. Oh, we have a highlighter. Not nice. Pen is only nice. Take red color. Take 4 lakh rupees deposit. Let's see in the passbook if this is it. Passbook, sorry, in the cash book if this is it. Yeah, 4 lakh there. Done. Next, what do I have here? 60,000. I have withdrawn money to pay furniture dealers. Is this 60,000 here on the payment side in the cash book? 60,000. Yay, it's there. This transaction is also done. Come to next one. 1,25,000. I've withdrawn the money to pay Das and Company. Is it there in the cash book as payment? Das and Company. Yay, 1,25,000. It's also there. Items are matching. These items are there in both the places. So these are not differences. Because these are not differences, these will not come in our PRS. Next, I have 35,000. J. Johnson and Company. It is deposit. It should be there in the debit side in my cash book. Is it there? Is it there? Is it there? Hey, 35,000. J. Johnson. Done. Next, we have with us 1 lakh rupees Roy and James withdrawal. It should be there on the payment. Let's say Roy and James withdrawal 1 lakh. Damar. Then what do I have next? Next. 76,000 Babu and Company check payment. Do we have here Babu and Company? Babu and Company? Yes. Wait, 78? Oh no, 76. 78. Something is wrong. Something is wrong. This 78 here. Oh, sorry. Sorry. Sir also does mistakes sometimes. Not like intentional mistake. I'm not testing you. By myself, I did this mistake. 76 Babu and Company here. 76 Babu and Company. 30,000 here. Deposit is there. It should be there on the debit. 30. There in the cash book also 30. Don't just watch this video like you're watching a Netflix movie and chilling. Open your ICS study material and then solve this with me. Then we have 50,000 here. Withdrawal. Let's see in our cash book, do you have 50? Yeah, that's also there. What do we have next? 43,000. J. Ryan brother. Here it will be there on the debit side. J. Ryan brother. 43,000. Everything is matching. Let's start now. 25,000. Why are you circling? Why am I circling? Because you should circle. Why? This 25,000 is there in passbook, is not there in cash book. So this is the first reason for difference. What is this? Premium paid as per standing instructions. I gave instructions to banker. Banker made the payment. I did not write it in my books of accounts. First reason for difference. Insurance premium paid on standing instructions recorded in passbook only 25,000. Then you have bank charges of 1,000. One more. Bank charges 1,000. It is withdrawal. Passbook balance is decreasing. Look at cash book. Have you written it? Why? Because banker has not informed you have not written. This is one more item which is there in passbook but not there in cash book. Right. The second reason for difference. Bank charges recorded in passbook only 1,000. Next one, interest collected on government securities. You have invested in some government securities. Luckily, government has paid you interest, you collected it. No. Usually government pays interest. You collected that interest, sorry, banker has collected that interest. Your bank passbook balance has increased. Have you written anywhere in cash book? No. This, my friends, the third reason for difference. Interest collected on government securities recorded in passbook only 20. By this, we might have done with everything in passbook. But my friends, in cash book, there are still some transactions left out. See here, this 1,05,000 and 34,000. What is this? Mohan 1,05,000, Nandi 34. This is checks that you deposited into bank after you collected check from Mohan and Nandi. But these checks have been not yet cleared. Checks deposited but not cleared. Do you remember? Do you remember? I told you reasons for difference. Same thing. Checks received and deposited but not cleared. 1,05,000 plus 34, 1,39,000. 1,39,000. Next, on the payments you have NACPAL 73, Babu 78. Together, 273 plus 78, 1,51,000. This 1,51,000 is checks issued to suppliers, but they have not presented to banker yet. It's not cleared. So this is checks issued but not cleared, 1,50,000. By this, I'm done with all the differences. If in case these green items, whatever is there in cash book and passbook are sorted, balance whatever is here, 2,43,000 would have been the balance here. But right now, as per passbook, the balance is 2,43,000. As per cash book, the balance is 2,37,000. Before the sir freezes to death, sir will turn off the AC and then continue with your BRS problem. So as per passbook, balance is 2,43,000. As per cash book, the balance is 2,37,000. There is clear difference. Balance as per passbook, 2,43,000. Balance as per cash book, 2,37,000. I've written both. What to do next? Now we need to identify whether difference between these two is only because of this or not. That is simple BRS. If the question only tells BRS, this is what you should do. No amended cash book. We'll start with balance as per cash book. So can you start with passbook? You can start with passbook, but only if cash book balance is not available. Whenever cash book balance is available, always start with balance as per cash book. I know balance as per cash book is 2,37,000. I know balance as per passbook is 2,43,000. And between reasons also, I know them. I just have to tell whether they are supposed to be added or deducted. I'll take not much time. Next 10 minutes. Come on, fatafat, let's do this. First one, insurance premium paid. When insurance premium is paid, passbook balance has gone down. Okay, this is my way of doing it. Some people do this, some people do this, some people do this and all. But I do it like this. This is C. C for cash book. Can you see? This is P. Like full times you have to say, ma'am, can I go to P? So P. That's the easiest way. I cannot make P in my hand. So this is P. This is C. Cash book, passbook. Cash book and passbook should match. If they don't match, we need to align them. Let's see. Insurance premium is paid. When the insurance premium is paid, the payment entry is made in passbook. The passbook balance has gone down. Passbook balance has gone down. Cash book balance has not gone down. Passbook balance has gone down. Cash book balance has not gone down. Can you see the P? No. See the P means straight line. Can you see the P? No. In order to see the P, either you would have to P up or you would have to C down. It's in your control. Started with C, cash book. What you do? You see down, down, reduce, minus. I'll write here, less insurance premium recorded in passbook only. It is recorded in passbook, not recorded in cash book. Because of us, there is difference. Starting with cash book balance, I would have to now record it. And this, my friend, is non-timing difference. It's not because of time. It's like you give 5 more minutes, that entry will magically appear. It's an error of clear, complete omission. You have to record it in your cash book. If you fail to record, balance will not match. So this is a non-timing difference. Why non-timing difference? What is the impact? I'll show it to you later in the video. For now, hold your horses and see the next one. Bank charges recorded in passbook. You recorded bank charges in passbook. Passbook balance has gone down. Cash book, you have not made the entry. Can you see the P? No. In order to see the P, either you would have to P up or you would have to C down. Either you would have to P or you have to C down. What's in your control? C. What will you do? C down. Meaning minus. I would write here less. Less. Bank charges recorded in passbook only minus 1,000. This again is a non-timing difference. Let's go to third one. Interest collected on government securities recorded in passbook only. I think I was so focused on the subject, that the moment charger fell down, I freaked out, had a minor heart attack. So don't tell this timestamp and then say, see what happened to sir at this timestamp. I'll kill you if you tell that comment. Okay. Interest is collected by the banker directly, because of which bank balance as per passbook has increased. Bank balance as per cash book has not increased. We're making changes in cash book. Sir, can you tell that C and P joke? Shut up, yeah. We're left with 5-6 minutes. We need to finish this question. Passbook balance has gone up. Cash book balance has not. We're making changes in cash book. We need to add. I will write 20,000. This is again non-timing difference. You have to make the entry. If you don't write the entry, it's your mistake. Then checks received and deposited but not clear. You have received the check. You deposited the check. You made the entry in cash book. Banker has not written the entry. When will banker write the entry? When it gets cleared. Cash book has increased. Passbook has not. We're making changes in passbook. What should I do? Sorry, we're making changes in cash book. What should I do? Minus. I'll write here less. Ta-da! Ta-da-da-da! 1,39,000 minus. This is timing difference. You don't have to do anything differently. Just give some time, check will get clear. Next one, check issued but not cleared. You issued the check, because of which cash book has decreased. It is not yet cleared. Passbook has not decreased. When will passbook decrease? When the check gets cleared. Till then, you just have to wait. Should you chant Gayatri Mantra 10 times for the check to get cleared? You don't have to do anything. Check will still get clear. So cash book has decreased, passbook has not. We're making changes in cash book. We need to add. Add. 1,51,000. This is again timing difference. Nothing of yours. So these non-timing differences are here, no? These are actually errors in cash book. I'll mark them in red. You have to do something about this. You have to make rectification in your cash book. These two timing differences, you don't have to do anything. It's a proper green flag. Husband material, wife material, just go ahead. Don't have any self-doubt. But these red things, no, the red flag. You have to ask them to rectify. If you rectify, you can think of something beyond. If not, stop it now. Better to get down now rather than go 2 stations further when you are on a wrong train. So non-timing differences have to be rectified. Timing differences, no rectification needed. Just it will remain in your BRS only. Now I'll teach you how to do ACB, amended cash book. Some people make a big fuss out of amended cash book. Oh, amended cash book like that, like this. Nonsense, nothing. If you know to do BRS, amended cash book is BRS made to look little different. You give a nice makeover to BRS, it will become amended cash book. So balance as per cash book, no, 2,73,000, 2,37,000. That will be debit side opening balance. In this BRS, if an item is less, it is payment right on the credit side or the payment side in cash book. In this BRS, if it is plus, meaning add, it is receipt, it should be written on the debit side. Simple. First identify all the items in BRS, classify them into timing, non-timing. Timing will remain in BRS only. Green flag, don't touch. Non-timing differences, whatever is red flag. See, add less, add debit, less credit, add debit, less credit. Start with balance as per cash book. See, if you want, you can pause this and then write it down and then continue. I would write 2,37,000. And here 2 minus items are there, no? 25 and 1. I'll write them on the payment side. Ta-da! And there is 1 plus item 20,000. I'll write it on the debit side or the receipt side. Ta-da! Now we'll find the balance carried down. 257 minus 26. Whatever you get is your balance as per amended cash book. This is the balance what will go to balance sheet. This is the balance which will go to balance sheet. You don't have to do anything crazy. 231 is the correct balance, rectified balance. This interest on government securities, insurance and bank charges are errors in the cash book, which are now rectified. What we did here is BRS, but this is before amending the cash book. Including these errors, but say these errors have been not rectified. With these errors being there, how will the cash book balance look? 237. Now that I have rectified 237, I have done minus 25, minus 1, plus 20. I have actually arrived at 2,31,000 to be correct bank balance. I will start with correct bank balance of 2,31,000. Balance as per amended cash book. And can I go to BRS balance as per passbook? Absolutely yes. What should I do? These 2 green items are there, no? They will continue to appear in BRS after amended cash book. Sir, what about these non-timing differences? They have gone from BRS to amended cash book. So let me take these 2 items, 139, 151, copy, 139, 151, paste. Now to 2,31,000. If you deduct 1,39, add 1,51,000, you'll arrive at 2,43. And ta-da! This is the balance as per passbook. Look at this. Also, it got the same thing. There are several questions that you can do on BRS after this on your own. Wishing you great success in all the questions that you'll do on BRS after this video, and also all the topics that you learn after, and also in the upcoming CA Foundation examinations and beyond. Vijayi Bhava from the team of Mission Yeshas. See you all in the next video. Till then, stay in the game. Go. That's it. Video is over. See you tomorrow.